Welcome to this week's series of Credent Connect. And today we're going to talk a little bit about the fourth quarter of 2024 as we're nearing year end, as we're nearing a new presidential election and some of the angst that can arise with that. But before I talk about that from a strategic and tactical standpoint on the investment management front, I think one important piece to note from a historical perspective is what it means to study the field of economics currently and in the future and in the past and things of that nature. And I'll explain why. One of the things with economics, starting back in the Great Depression era, right, post the Great Depression, fiscal policymakers, the government, they wanted more robust data to be able to make decisions. And it forced economists, post-Great Depression, to treat economics more like physics, meaning if I move this pen from here to here, what's going to happen everywhere else? The reality is economics is not physics. It is not a defined art. Therefore, when economists lay out estimates for the future, when economists predict outcomes that may occur, when economists give broad range of outcomes that could transpire, it's really important that such data be viewed so objectively, right, to gauge in the fact that that is a pure guess, and there is actually no physics type math behind it, despite what some econometrics models may tell you, right? Really kind of getting in the weeds of those individual models. The reality is economics is not physics, meaning we have to take all those estimates, all those outcomes with a grain of salt and really step back and actually look at the consumer, look at the earnings data, look at the trends, and use that as our basis for decision making. The reason I bring this up is leading up to now October of 2024, so far this year, there's been this sentiment of a recessionary backdrop. Hard landing, soft landing, is it going to happen? What could it mean? What does it look like? And there's risk to both outcomes. Planning for a full recession to occur and one doesn't, that poses risks. And planning for one not to occur and actually does occur, there's also risks to that, especially from a total return standpoint, a risk management standpoint. The reality is stepping away from that rhetoric, right? Understanding what it is from an economic standpoint, but looking again deep into the earnings data, the consumer, that's where the most value transpires, which is how we approach the decision-making factors for investing across capital markets. With that in mind, right, earnings season is now among us again here in the fourth quarter, early in October, and it's going to continue through the end of October and into early November, especially as we're nearing the presidential election here, November 5th being voting day. Earnings data looks substantial on a relative basis to the previous quarter, right? Very healthy, robust, on path. Doesn't mean it's going to continue perpetually in that regard. But if you look at where we came from to where we're at today and where that forward guidance is leading us to potentially be here over the next 3 to 6 months, equity market participation still makes tremendous amount of sense relative to the market's perception that we have to be overweight fixed income because of this disinflationary trend, right? As inflation comes down, so must interest rates. But buyer beware, right? One of the things we've been keen on this year is not to overdo fixed income exposure, right? Bonds. The reality with bonds is, yes, they will make money as rates come down. But this inflationary trend that has seen a downtrend so far this year has now bucked that trend and maybe ticking up slightly higher. As that likely occurs, we have to understand why and should we be scared of it. The reality on the why is the consumer looks fairly healthy still to this day. Earnings data is supporting that, right? Yes, the labor market is seeing a little softness, but on a relative basis to everything else of the past 20 years, the labor market looks fairly robust to be able to sustain this economic activity. And if you recall, even from 6 months ago, maybe you don't, maybe you do, maybe you don't, we have been adamant on the fact that we're not going to see 2% inflation again in this country on a perpetual basis, probably ever again. Meaning our new normal is that 2.5% to 3.5% range. And simply because we have bucked the current trend doesn't mean the next leg up is 6 or 7%. It simply means we're entering that new stage of a new normal that when managed appropriately across equities and bonds, more on a long-term basis, which is how we approach these allocations, we believe that tends to be the best outcome for long-term success. So the takeaway here, right, going into year end, the inclination is going to be to want to get out of the market. The inclination is going to be to try to get ahead of any potential volatility due to a political outcome that may transpire. It may be a need to get out of the markets from a geopolitical issue that's transpiring. The reality is there is always a reason to exit equity market participation. Always. Times of war, times of peace, times of political changes, it doesn't matter. What matters is the long-term adherence to your financial plan with a very, very kind of objective, structured equity market participation investment strategy that you are likely all invested in today. Stay the course. The noise is just that, it's noise. 6 months down the road, irrespective of what happens today, or what happens with the election, or what happens with the labor market, or any sort of trend in inflation, it will always be a retrospective fact with no crystal ball that will define exactly what you should do. And if history is any guide, it tells us to remain objectively invested, follow a financial plan, and rule out and ignore all the noise.